maybe I should just invest into tech stocks in the US, bank stocks that are just too boring, too slow.
The US serves a different niche, a different type of investor, a different type of person in the markets.
Okay, time to do a bit of portfolio rebalancing. And then, that's always a good thing.
Not everyone trades,
Yes.
but everyone needs to invest and put their money away and think about income. And so I
beat
think
inflation.
and inflation, beat inflation. And I think that's one of the great ways to do it is in Singapore banks.
And it also gives me money, so it's like...
And it gives you money as well.
I know, right?
Instead of taking money away from you,
Yeah.
like most children.
Struggling to keep up? Welcome to the FOMO Fix. Welcome back to the FOMO Fix. Quick question. Are you interested in investments that offer stability and steady growth? Well, but if you're looking for something even more exciting, hang tight because you might discover why bank stocks deserve a second look. I'm Hazelle from The Joyful Investors, your navigator on this journey to financial empowerment. And joining me today is Tim Phillips and Amos Chan.
Thank you, Hazel. Hi. So I'm Tim Phillips. I'm founder of timtalksmoney, and I've been in the investment industry for around 15 years. I'm really passionate about creating content that is bite-sized for investors and really encourages longer-term investing. I'm also a certified SGX Academy trainer. So I'm really looking forward to talking about what we have to talk about today.
Hi everyone, I'm Amos and I work in finance. Have been working in finance for 5 years and also investor by the side. I'm glad to be here.
All right, so in the last 1 year or so, we have actually witnessed significant growth in many of the Singapore bank stocks, which was driven by the rising interest rates that has propelled these banks to actually reach record profits. So in this episode, what we are going to do is to dive deep into the world of bank stocks and discuss some of the principles and strategies that investors should understand before jumping into these investments. All right, so for us to have a quick understanding, right, Amos, are you currently actually invested in any of the bank stocks, be it locally or globally, for your equities portfolio?
Yeah, for me, I have DBS in my portfolio. I picked it up around the time when the pandemic started. So I've just been dollar cost averaging into it. So it's become a core part of my portfolio, along with some REITs. But that forms the basis of my local portfolio.
Okay, so if you don't mind sharing, what are your actually overall investment theses on bank stocks? Are you, very bullish in the long term, the short term, and so on?
Yeah, so when I was young, my dad kind of always harped on the importance of passive income. And he always likes to over the carrot that, I invested in UOB when it was very cheap. And then you need to do so as soon as you can. So when the pandemic happened, I saw DBS was at, I think $28. And I was like, okay, time for me to get a bank stock, because up until that point, I was only doing like REITs and like other local stocks.
Okay. So it's the mindset that he has been, pushing for over the years.
Yeah.
Okay. Then do you actually find bank stocks, complex for you, like as compared to other companies, other businesses?
Yeah, for me, I'm not really the kind that when I was starting out, I was not really the kind that always looks at the ratios and all the different calculations. So for me, I'm a very dividend investing focused kind of person. So for me, I just go on sgdividends.com and see, which is the highest dividend yield. Oh, wow. It happens to be the banks and REITs. Okay, I'll just invest in those, So it's I'm a very straightforward layman person. So it's DBS is at this price. I just kept dollar cost averaging until it became, it's quite big now, Yeah.
Okay. Yeah, because why I asked that question, right, is because I think a lot of investors find banks in general more complex to understand, right? So maybe, Tim, you could share with us, how do bank stocks actually differ from stocks of other industries? Why are they deemed to be more complex?
Yeah, I think it's mainly to do with the net interest income and the spreads on loans. And so I think their structure and their financing structure is very different to traditional businesses, how they lend out money, how they take in deposits. And so a lot of the more traditional ratios, which Amos had mentioned, like price to book, might not be applicable to industries like technology, but it's very applicable to an industry like a bank because it's very capital driven. And so in the similar vein, something like the macroeconomics might not affect individual companies or sectors so much, but with banks, it's very sensitive to fiscal and monetary policy. And so from that perspective, if you think about investing into banks, you might have to pay a bit more attention to what's happening in the macroeconomic sort of view and also in the global economy.
I see. So banks, they're actually operating on high leverage, right?
Yeah. Obviously, when banks take in deposits, they then are lending that out at a higher rate. So they're not going to pay you very much interest, as we can kind of see with banks nowadays in Singapore. They don't really pay you much, right? So you get that money in, they give you the token or whatever it is, 2-3% like it is now, and then they'll lend that out at maybe 4-5-6% at closer to what the risk-free rate is, or slightly higher. And so that spread between what they're paying you as a depositor versus what they're lending out to a borrower, that's their net interest income, and that forms a big part of their profit on a regular basis, quarter to quarter, year to year. And so they are operating on that leverage. But banks in Singapore are very solid as well. They have a lot of capital ratio, they have a lot of capital buffers rather, that help them reassure investors that nothing is going to happen. There's going to be no Credit Suisse type incident, So we saw that with banks last year. Singapore banks and even Asian banks really didn't react so much to the fear in Europe surrounding Credit Suisse, because they're traditionally in Asia, we've had banks that have been very, very solid and very, very capital heavy.
Right. So on the point where we talk about how banks operate on high leverage, right? One way to actually look at it is also if you look at their balance sheet, like if you compare the liabilities to their equities, oftentimes you can see the liabilities is actually much larger as compared to their equities.
Yeah.
Like for example, if you use the 3 local banks as a very quick example, liabilities to equities is about 10 times or 11 times the size, right?
Yeah.
But if you look at other companies in other industries, often the proportion is not like that. So in that sense, is it right to say that because they are more highly leveraged, so bank stocks could be potentially riskier assets? Would that be right to say?
In a nutshell, you're right, that they definitely leverage up on the balance sheet side, but it also depends on the liability side whether those loans go sour, right? Traditionally, we've just seen from the recent bank releases and their earnings that non-performing assets or non-performing loans or NPLs are usually in the 1% or less range. So unless you have really a massive depression and rates and NPLs go up to 10, 20, 30%, which is really unprecedented in terms of it happening, then I think it's not going to be as risky maybe as the liability side shows on the balance sheet.
Yeah. But what's really interesting about banks is that they are really deeply intertwined with the economy, right? And that's why there is such a systemic importance to make sure that they are highly regulated. Like I have like friends working in the bank, so when they talk about their work, they are often talking about all the compliance that they have to meet, right? That's part of their work. Because imagine if a major bank fails, right? There would be very serious and widespread ripple effect on the entire economy. So in terms of that, because they operate on high leverage, right? A lot of people, they actually struggle to understand how banks really make money. What are the different kind of revenue streams? For Amos, is this something that you also struggle to understand?
When I was starting out, I really didn't know any of this. But as time went on, I slowly understand of what the banks do.
Okay, also what's your impression of how banks actually make money?
Well, they do lend out, and that's what Tim said. Then they do expect returns on whatever they lend out. So there's also because I also have friends who are like RMs in banks. They're always like pushing all the different products. We all know. So it's like but I think like to a layman, if the banks do fail, I think it'll be very catastrophic. I don't think the stock price would be the first thing that they'll come to mind. They'll probably think like, oh no, my money in the bank, that kind of thing. Like bank runs, for example. But I'm just glad that Singapore, I think MAS have very good regulations in place to actually control the banks, which is very important. It's something to point out. So that's why my fellow investors around my age gap, they also around my age range, right? They'll always say like, oh, okay, it's safe to invest in banks because the MAS is like protecting the banks in a sense, like.
Yes, the regulations that in place.
I think that's a good point, because I think the MAS is very strict with its compliance, but the banks have benefited from that, and also the Singapore economy has also benefited from that. So obviously, when you are very strict on the compliance side, there are going to be cons to that in any case, but on the pros, I think the pros outweigh the cons, and we've seen that with the strength of the banks. And so I think Singapore banks also are similar to other banks in the region, whether that's in Hong Kong or elsewhere in Southeast Asia, is that after the Asian financial crisis in 1997, they became a lot more conservative in terms of their balance sheet and how they created those equity buffers for loans that go bad. So I think that culture and that sense of conservative in terms of its approach to capital buffers is definitely something that differentiates Asian banks and particularly Singapore banks from maybe what you would see in Europe or the US.
So earlier on, you talk about the net interest income, right? So that
Yeah.
is one revenue stream for the banks. Are there any other types of revenue streams for banks typically?
Yeah, so as you said, net interest income, which is also use the acronym NII, and then beyond that, it's non-net interest income. So that's
Okay.
basically everything else. So you have things from wealth management fees, you have the cards business, those types of inflows. That's where they make a lot of their money, and sort of treasury income as well. So there's a lot of different flows beyond just the actual net interest income, the NII. And so in Singapore, what a lot of people have been saying as one of the drivers to actually accumulate the Singapore banks is their wealth management businesses are really booming. They're doing very well. They're growing their base. They're getting more fees from wealth management. They're challenging the likes of UBS, who are very big in Asia. So I think there's a lot of optimism surrounding that. And then credit cards, people are picking up
Yes.
spending. They're starting to spend more. They're going overseas. Obviously, UOB, OCBC, DBS love us to spend in a different country because they make loads of credit card fees on overseas transactions. So people who go overseas and spend, that's where the credit card companies and particularly the banks who issue these credit cards, that's where they make a lot of money as well.
So adding on to your point about the different type of revenue streams, so they have NII and also the non-interest income, right? So if we just use DBS as a very quick example, net interest income, it contributes about 68% of the total income already.
Yeah.
Then the remaining 32% actually comes from the non-interest income, like the fee incomes that you mentioned about. So maybe just for our audience to actually understand a little bit more. So some of the main business units include consumer banking. Which I think we are all very familiar with because it's like, we have all the products like current and savings account. We have like those home loans, investment products, insurance, and so on. Then they also serve institutional clients, right? Like companies, SMEs, financial institutions, and so on, where they provide short-term working capital as well as like longer-term loans and so on.
So like trade finance, that type of thing.
Right. So these are some of the common things that are actually going around inside the bank. Okay, which many people actually find very complex to understand. But hopefully, with the explanation from the team, right, it has become much more clearer in this sense. Okay, so moving on, if we take a look at the stock chart, the price of the three local banks in 2024. Now, year to date, at one point in time, they were actually up about 20% this year before they went through some decline from their all-time high. So when going through all these price fluctuations, like prices going up, coming down by 10%, 20%, right? Amos, for yourself, how do you feel going through all these price fluctuations?
When it goes up, I feel very shook.
Very shook. Okay, indeed, right? Then what happens when it goes down?
I have trouble sleeping at night, the usual.
Okay, I think because that's like something that many retail investors, they also feel as well, right? Because after all, we are human beings, right? So you can't say, totally 100% no emotions. That's quite impossible. So maybe one good way for investors to get over this, maybe is to understand logically, what drives these stock price movements.
So I mentioned previously about how their actual businesses are much more tied to the macroeconomic cycle. And similarly with the share prices, a lot of the sudden movements are more tied to what's happening maybe in the US with Federal Reserve, with interest rates, with the interest rate cycle, with the global economy. So if there's fears, and there was heightened fear in recent weeks about the global economy going into recession, or the US economy going into recession, and how that would be terrible for loans, wealth, etc., that type of business, that's very much tied to what the banks do and how the banks make money. So in the short term, that drives, I think, the prices. But over the longer term, you have to look really at the profit generation, the cost controls, the earnings per share, and how they've been able to grow that. And so even in the low interest environment, which we had from say 2009 to 2020, the banks did okay. They didn't do great. But as soon as we saw interest rates really rise quickly, as we did in 2021, 22, and we saw their profits start to also snowball. And so that's where you saw the share prices really start to take off again. So I think these types of, as you said, you mentioned 68%, because 68% comes from net interest income, that's a big portion. And that type of interest rate sensitivity that would drive the share prices in the short term and what happens in the global economy.
So if I could actually pick up what you have actually talked about, I think the word is probably sentiments, is it? Sentiments that would drive all this.
Yeah, because nothing's actually happened, right? On the interest rate side, they
Yeah.
haven't actually, the Federal Reserve still kept it at 5% or whatever it is now.
Yes.
But it's the expectation of the market. The market maybe
Okay.
prices in these cuts. And whereas previously there was very, very strong data out of the US economy, so the market thinks, oh, they're not going to cut interest rates. But then the jobs data starts to weaken, the inflation comes down, the economy might go into recession. So now suddenly it flips, the narrative flips, and then everyone's saying, oh, there's going to be a recession, so they're going to cut rates. And so you see Singapore banks perhaps maybe fall a little bit. But I don't think Singapore banks are as volatile as maybe tech stocks in the US or anything like that. It's much more stable type of price movement, and it's more, as I said, related to the macro and the interest rate sentiment and the expectations. More importantly, what does the market expect is going to happen going forward with interest rates? And you'd see Singapore banks maybe move in line with that.
Yeah. So actually, in the last couple of years, there's this event that's related to the banking sector, which was last year actually, March 2023. There was the U.S. regional banking crisis, right? Where there are some banks like Silicon Valley Bank that collapsed and so on. So although it's affecting only the regional banks, but actually like the U.S. major banks like J.P. Morgan and so on, they also went through a very sharp price decline. So a lot of this actually they are driven by all the sentiments, expectations, right, that people have. And I believe even for Singapore banks, they also went through some price decline at that point in time, although maybe not as sharp as in the US bank portion.
Yeah.
But at the end of the day, what's most important is over the long term, the fundamentals, right? Whether it has changed the profitability of the banks. So those are things that matters, right? If it hasn't, then it could be a good buying opportunity.
Yeah, definitely.
But if there is any change in fundamentals, then yes, that's where we have to relook at the investments.
Relook at it. Yeah, that's correct.
Okay,
definitely.
so another thing that we definitely have to talk about in this session, right, is in terms of how do we evaluate our bank stocks, right? So before we hear from team, maybe let's hear from Amos first. So how do you actually decide, okay, I want to invest in this bank versus another bank? What's the thought process like for you?
For me, I actually prefer DBS, but I think it's also because I use DBS as my card and all. But when I'm starting out investing, right, one of the main things I was looking for is the dividend yield. So I actually just chose DBS in the end based on I think it was a Seedly article that I read all the way back then that compared all the 3 different banks, and in the end I decided on DBS. So that was my choice.
The dividend yield is higher, is it?
Yeah, and also the other pros and cons mentioned in the article. Yeah, because when we are starting out an investor, you actually want to have as many information sources as possible. So normally you just go to whatever everyone is using at the time. So
okay. Yeah. So could you share, other than dividend yield, what are some of the things that you actually look out that time? Do you recall?
Oh, leadership also. I think
leadership.
The CEO was pretty good at the time. Also, I know he's changing out to a different, but it's been a good 15-year run in DBS.
Definitely. Yeah, it's been good.
So I do look for at least there's a corporate direction for the thing. So at least we know where the bank is aiming towards, that kind of thing. Yeah. So so whenever I get those statements from the banks, what's that, for the AGMs and all, I do at least read through. Oh, what's next on the table? Yeah.
Okay. I think it's good to understand what's in the plan, right?
Correct.
Yeah. So maybe team, you can share with us what are some of the top metrics that you think investors should actually look at before they jump into investments, like dividend yield, is it?
Yeah, I mean that is definitely one. I think in terms of where you want, how much yield you want initially to get. There's price to book. If it's cheaper, maybe it's more valuation, but I don't think that should really directly impact you saying, oh, just because it's cheap, you should buy it. I think it's just one of many metrics.
Yes.
There are other things, as Amos was saying, just the leadership. I think DBS has had a great leader for over nearly 15 years, and now it's changing hands. Yeah. But it's a really strong franchise. And so there are other maybe more intangible things. The more tangible things would be really just any business fundamental metrics that you might expect. Loan growth expectations, or how strong have they grown their loans over the past 1 year, 3 years, 5 years, and how do they expect it to grow in the next 6 to 12 months? Non-performing assets, your non-performing loans, you want that to be lower. The dividend growth, rather, is very important, because I think a lot of people do focus on the yield, which is one component of it. But also, you want your capital that you've invested, you want that to generate more dividend income each year. So for me, looking at the 3, 5, 10-year dividend growth per share is really, really key. And I think that is where you'll find, well, I agree with you about DBS being best in class. That's how I think it's shown itself in its track record. If we look over the 10 years for 2014 to 2024, we've seen UOB and OCBC grow its dividend per share at around mid 9% range, but DBS has been at 15% compounded, right? So it's a very different way of looking at it. And that's how I would think about also looking at banks in terms of their quality and is that dividend sustainable? And with all three banks, the dividend is sustainable. It's been pretty sustainable and they've done all quite well, but DBS has been about 6 percentage points ahead over the past 10 years.
Right.
Yeah.
What about liquidity ratios? Like maybe in banks, right? They have this CET1 ratio. So
Yeah.
How can actually investors look at all this?
Yeah, so CET ratios are the core equity tier 1 ratio, which is looking at your capital buffer. There are, in terms of regulation, there are minimums. I think it's around maybe 11 or 12%, the exact range, but a lot of banks have a lot more.
Yes.
And if they have excess, that also allows them to perhaps pay out a special dividend or buy back stock, and that will benefit shareholders as well. So if they see that there's too much excess capital sitting on the balance sheet, which is not being made good use of, then they may redistribute that to investors. So we've seen talk about OCBC having a lot and maybe potentially giving out a special dividend. We saw DBS give out a special dividend, I think last year, and that was because they had excess capital. So I think there's opportunities to look at how much capital they're holding in terms of that buffer. And if management deems it to be in excess of what's required or what's conservative in terms of how they feel they need to utilize it, then you could potentially actually benefit from either a special dividend or some series of buybacks.
So you mentioned about where your CET1 ratio is above the requirement, then there is more buffer, right? So they can actually use this also for their expansion of the business.
Yeah.
Right. Like for example, OCBC, they actually recently increased their stake in Great Eastern.
Yeah, they bought it out, right? Yeah, so they're buying out their stake.
Yeah,
in Great
and that's
Eastern,
also possible because they have a lot of this buffer.
So
and
that allows them for business growth as well. So
definitely.
That's also, so I think it depends on whether they want to use it for business expansion or shareholder returns.
So these are really some of the important ratios that investors can look out for before they go into that investment, right?
Yeah.
So earlier on, we talked about interest rate. Now, this is a really very important topic when it comes to banks, right? So, Amos, what do you actually think about interest rates, the relationship with banks? What's your understanding on this?
Okay, so I understand that if the interest rates increase, it gets more expensive to borrow stuff, right? Companies want to borrow from the banks, but the interest rate is higher now. So then there was a nice video by Ray Dalio that talked about this. So I'm trying to recall. If the interest rates increase, it will be more expensive for companies to borrow from banks. And this in turn affects the companies and their stock prices, right? Down the line, the spending will also be affected. Like if it gets more expensive to borrow and pay back stuff, then people will spend less. And this in turn affects the economy, correct? Something along those lines.
So right now we are in the elevated interest rate environment. So how does this actually impact the bank's performance?
As you were saying, it becomes more expensive to borrow for companies.
Yes.
But that maybe doesn't necessarily translate into really poor business conditions, because interest rates typically rise when an economy is overheating. And so we've seen that in the US, they hiked interest rates because there was such strong growth and there was such strong inflation that really they had to raise interest rates to cool it down a little bit and make it less hot, and otherwise inflation could have run away. So in that sense, the economy in the US is actually still doing really well, and the global economy is still growing. So higher interest rates are an effect of perhaps higher inflation and overheating growth. And so the US Federal Reserve, which is the biggest central bank in the world, they want to get that down to an equilibrium of inflation and a balanced economy, not too hot, not too cold, sort of a Goldilocks economy, as they say. And so bringing the inflation down is what they've been doing. And now they're focusing on making sure the job market is healthy. So in the US, they have a dual mandate of jobs, and they also have the inflation rate. And so now they're focusing on both. And if they do manage to do that successfully, then I think the global economy should be fine. And they can take interest rates down a little bit, and that will help other businesses, perhaps not banks, as I said. If it comes down, then net interest income will also come down.
Right.
But we've seen in Singapore that they're taking measures at the banks. The management teams have talked about putting certain capital loans, rolling it over into longer term duration loans, and sort of bringing that sensitivity down to however much the interest rate might be cut, so that they won't be losing so much money per 5 basis points, 10 basis points of cuts in net interest income. So there is a lot of mitigation at the banks. I think they realize that there are interest rates coming, and so they're taking preventative actions to make sure it doesn't impact their business so much.
Yeah, because
Yeah.
right now, there's actually, if you look at the CME Fed Watch 2, right, there's actually 100% chance of a rate cut
Rate cut. Yeah.
in September, right?
Yeah,
So
yeah,
it's more
yeah.
of a debate whether it's 25 basis point
Or
or 50
50,
basis point.
yeah.
But yeah, we're expecting a rate
Expecting.
cut coming soon.
Everyone's expecting
Yes,
it, right?
yes.
Yeah.
So I definitely agree with what you have shared, right? So when the interest rates comes down going forward, maybe there might be some compression in the net interest margin, right? Where they are lower than the highs that was posted last time in 2023. But because banks, right, they have many different sources of revenue, not just in terms of net interest income. So earlier on, you mentioned about fees as well, right?
Yeah.
So if interest rate comes down, people might shift their funds from the the risk-free assets that are giving lower interest rates to the higher risk asset, and that would benefit
Definitely.
the
banks,
wealth management.
management.
The
you
wealth
got it.
management sector. So
Yeah.
fee income could be an accelerator of growth moving forward, right?
Definitely. Yeah,
Yeah.
you hit the nail on the head. I mean, we've seen a lot of stats about how much quote unquote dry powder there is, funds sitting on the sidelines in money market funds or savings accounts.
Yes.
And once interest rates come down, maybe markets are going to take off and people will start to feel more confident to invest because the risk-free rate is coming down. So that on the flip side could benefit the bank's wealth management because they have so many products, as you were saying, Amos, to sell, right, to people. So they're going to be selling products, they're going to be pushing investments, and people who want to earn a higher return versus an interest rate which is coming down or a money market fund yield that's coming down, they're going to start putting money into products, into investments, and that will benefit the bank's wealth management
definitely.
divisions. Yeah, for sure.
And Amos, you mentioned about loans, right? So with lower interest rate, that might drive the loan growth already, right? So all these are possibly accelerators of growth for the banks in the upcoming years.
Yeah.
Now, but what happens if, let's say, the economy sinks into a recession? Typically, we know that banks are more cyclical. They tend to do better during the good times. Then during the recession, they tend to, don't fare as well. So during times of recession, as a retail investor, Amos, would you feel scared or fearful of holding on to bank stocks or accumulating bank stocks?
Yeah, I would be quite scared to accumulate more bank stocks because I think if it's a recession and people lose their job, they lose their income and they have actually got more things to worry about than investments. So the chances are people will cash out for some of their investments just to sustain their lifestyle or to at least be able to put food on the table, Yeah.
Yeah. So then, Tim, what do you think? During a recession, right? How should we assess the bank investment then?
Yeah, I think investors should just take comfort from the fact that, as you said, it's cyclical, right? So there are ups and downs, and it happens every 5, 10, 15 years or whatever. There will be another recession. We know that will happen. That's 100% certainty.
Yes.
We just don't know when.
Right.
So it's more about taking comfort from the fact that we know there's going to be a recession, but we also know there's going to be a recovery. Just like we've seen every recession, there's a recovery. So I think that's how you should try and view it in terms of accumulating bank stocks. And personally, I think if you did want to buy bank stocks, maybe the recession's a perfect time to get in and dollar cost average into banks
at a lower price.
At a lower price. And then eventually there will be a recovery. But you have to be patient. I think that's the one key aspect of it, is having the patience and the discipline to understand that it will recover. Even though we do go into recession, it will recover. Look at 2009. That was one of the worst recessions in living memory, and everyone recovered from that, and all countries and economies recovered from that. And we saw the banks recover from that and do well. So I don't think it's something to necessarily try to time and put a load of money in at a certain point. Maybe I would personally, as you were saying, it was just DCA or dollar cost average into the banks as the recession hits, because that's probably the best time to accumulate the bank stocks.
Timing the market beats timing the market.
Timing the market, right?
Good old saying.
And you don't want to, I think dollar cost averaging is more psychologically beneficial for you. You don't need to think so much about it and worry about the timing. And so, so I think that's a key portion of the psychology of when you do buy bank stocks. maybe the recession, maybe when everyone's heading for the exits, that's the time to accumulate them and buy them at a higher yield when they're yielding a higher amount. And then eventually the economy will recover, and banks, as you said, cyclically, they'll recover alongside the economy.
So you can be more greedy when there is fear.
Yeah, you can be. It's harder to do it though. That's the problem.
Yes, it's harder to do it.
It's easy to say it, but then when you actually go and do it, it's not very easy. So
Right.
you've got to actually pull the trigger and buy, and that's
Yes.
not always easy when things are red, right?
Yes, yes. So we've talked about interest rates, we've talked about recession. Now, recently there was this Japan market crash, right? Which was due to the unwinding of the yen carry trade, and it has actually spread to the global markets, the Asian markets, US markets as well. So, how do you think this might impact the bank stocks? Would there be any impact on them?
I think from the actual specific Singapore bank stocks, it has really no impact on Singapore bank stocks. I think this is a trade that got overcrowded. The yen carry trade, just for listeners, is basically the Bank of Japan has a very low interest rate. It was previously negative. They borrow in a low yielding currency, traders, as they borrow in the Japanese yen, which is very low yielding. It's cheap to borrow. And then they buy into high yielding assets that give higher returns, like US tech stocks and US stocks.
Right.
And so that unwinding, when the Bank of Japan raised its interest rate and the Federal Reserve looks like it's going to cut its interest rate, people freaked out, and there was an unwinding. So it really has nothing to do with Singapore and the banks in this region. So I think, again, it's one of those cases of this is just a story that happened to impact the region and global stocks.
Yeah.
And it was probably a good opportunity. In hindsight, we can always say this, but it's probably a good opportunity to accumulate some bank stocks, because since then they've recovered, right? They had a big plunge of 5-6%, which is big for Singapore bank stocks. But then they recovered, and I think they're back to where they were just before that whole crash happened, right? So I think it's more of a specific trade, and there's a bit more of that going on versus there's nothing wrong really with Singapore banks, because there isn't. It was more
So the fundamentals,
are still intact. Yeah, it was more the market freaking out, and that happens from time to time, and that's very normal again.
Yeah. So if I could sum all of this up, in case our audience, after listening to interest rate, recession, market crashes, they start to get more fearful about this, right? And they don't dare
be
to
put
go
to
into
sleep. Yeah, it's not that exciting. In terms of interest
So
rates.
I think what's most important is really focus on the fundamentals, because that's what would drive the prices over the long term. And as long as the fundamentals are intact, right, then that could be a good bargain buying opportunity, right?
Yeah,
then unless there is really change in fundamentals, then yes, we have to relook at the investment.
That's correct.
So
totally
so
true.
that's always the kind of mindset that we should adopt as an investor.
Yeah, definitely.
Yeah.
I think it's more about the fundamentals, as you said. If it's nothing impacting the fundamentals, don't worry too much. You talked about the regional banks in the US.
Yes.
And JP Morgan, and that's an example from the US perspective of, it's impacted all these regional banks. But then you see JP Morgan. Actually, it was probably a good time to accumulate JP Morgan. JP Morgan now is just so big and has gone on to greater heights, and as the share price has done even better than those regional banks, right? So it's a very separate issue, and so I think that's the same with Singapore. They've just been affected by the sentiment, and it's not affected their fundamentals whatsoever.
All right. So on top of interest rates, recessions and all this, right, are there any other trends that you see in this banking sector?
I think from the perspective of Singapore banks, I think the trend is a bit more towards regional expansion and maybe trying to grow their regional businesses. Because as we know, Singapore's a very small city state, so there's not as much growth opportunity in here for the banks. So you've seen them growing a lot more in Southeast Asia. So I think that regional expansion is probably going to continue. They'll try and continue to grow that expansion through their digitalization as well. I think Singapore banks have done a really good job of digitalizing their offerings and actually putting off those upstart digital banks that came in. There was a lot of fear, right, when Singapore digital banks were like, we've approved all these digital banks, but they haven't made as much of an impact as you would have expected. And it's because I think the Singapore banks, the big banks, have upped their digital offerings, have done a really good job of that. I think that's pretty exciting for investors.
Right. So
Yeah.
previously, before we started this recording, right, I was actually chatting with Amos, and he was sharing with me, he actually invests in some of the US stocks like, Nvidia, right?
Ah,
Which
yeah.
has been
Yeah.
really at the center of the attention, right?
Yeah.
For quite some time. So when you talk about Nvidia, right, the word that you think about is AI, right? So AI, would this be any relevant to the banking sector?
Yeah, I think AI is definitely an area that could help banks become more efficient. I think when you were talking about the ratios to look at as well from evaluating bank stocks, there's also something called a cost to income ratio, which is the CIR. And that's basically how much are the costs as a percentage of their income. And so the lower, the better, right? They want to get those cost
Yes.
efficiencies down. So we've seen with DBS, there's a lot of talk about digitalization and trying to be more efficient and lean. And we're going to see that, I think, with UOB and OCBC as well. They're trying to get the cost income ratios down. I think AI will probably play some part in that. There is definitely scope for them to maybe bring down the CIR from rolling out AI functions, maybe it replacing certain customer service functions, and maybe freeing up time for their staff to do other things that are more productive that can generate more revenue for the business. So I don't think it's necessarily going to be something that happens immediately. We see with these kinds of trends like the internet, when it came, there was so much hype around it, just like with AI, but you don't really see the benefits of that trend until maybe 5 or 10 years down the road. But the initial hype is there. It dies down maybe, like it might with AI, but then we might see those benefits start to accrue in 5 to 10 years. And that is when I think the Singapore banks could show investors what they've done with AI.
And I think a lot of investors would actually be very excited about this as well.
Yeah, definitely.
So for Amos, right now, in terms of your portfolio allocation, how is the DBS Bank stocks like versus the other equities?
Oh, because currently I invest in banks,
As well as
REITs,
others.
and US stocks. So I still have a quite a substantial portion in the banks for myself because I only liquidated like a bit of it when the price for DBS was around 37 because I felt that all-time high is time to take some and then chuck some of that into Nvidia. So like the
Good timing.
portfolio.
37. That's a good price on DBS. Yeah.
Yeah. Thank you. Yeah. So it's like, okay, time to do a bit of portfolio rebalancing.
Yeah.
And then that's always a good thing. Because I mean, for me, my risk appetite is still very high. I still have quite a long runway. So I decide, okay, now that I have stabilized my Singapore portfolio, it's time I explore more into the US, like the overseas markets, So at least that's like
Okay.
Eventually I aim to have like at least a 50-50 for that. But then
50
maybe
Singapore, 50
yes,
US.
correct.
Okay.
Yeah, then maybe as I get older, I'll just like cash out from US and just like build like a bond portfolio or something. Yeah.
Okay. Yeah. So portfolio allocation will be something that's very important, right? For investors to look at when they're building up the bank equities.
Yeah.
On top of portfolio allocation, are there any other strategies that investors should look at also?
I think understanding your geographic exposure. I mean, we will talk about US, and US is the world's biggest stock market. It makes up over 60% of the global market cap. So of course, everyone should have some US in their portfolio. But I think if you're living in Singapore and you're interacting with these businesses on a daily basis, it's a good opportunity to start investing if you are new to investing by investing a little bit into your local market as well. So, and we can see that DBS and UOB and OCBC as the bank stocks, the big banks that everyone has a relationship with in some form or the other. That's probably one of the best places to start investing in Singapore, because they have some growth opportunities. They have a decent dividend yield. They are able to grow those dividends, which I think is really important. You don't want to be having a dividend stock or a company that just has a yield of 6% but doesn't grow its dividend every year or just pays the same, right? You want it to grow. And so all three banks have grown their dividends. So I think that's really important as well. And above inflation, right? We want the dividend per share to grow above the inflation rate, and they've all managed to do that. So I think it's important to have some stake in local businesses and local stocks, and it gives you a flavor of the local market, understanding how it works. And the bank stocks are the biggest. They're the big boys in Singapore, right? In Singapore Exchange.
Definitely.
So I think they're definitely worth having an allocation to. It's just depending on how you size your positions, how you put that versus maybe what you have in the US or what you have in ETFs, because there's the people who have maybe just stocks, maybe people who just have ETFs. I think it's okay to have both, and there's nothing to say that you can't own some stocks and own some ETFs as well to complement it. But if you are starting out in Singapore, I think bank stocks are really a great place to begin that journey.
Yeah, and like Amos have shared, it also depends on your current phase of life, right?
Yeah.
Or to determine on in terms of the portfolio allocation, whether you're more on Singapore right now, or maybe in the future 50-50, right? What we have actually mentioned about.
Yeah, because I think like younger people, they have a bigger risk appetite, and that's where maybe you go and buy the Nvidias or the Teslas and see that price action. But I don't think there's anything to say that you can't do both. Like you Amos, are doing both, right? You're doing DBS and you're doing
the
Nvidia.
US stocks,
so
yes.
I think it's good practice, because it also allows you as an investor to get exposure to different types of stocks and businesses, and not just maybe focus just all on tech stocks, or all on banks in Singapore. You want to have that diversity and understanding of different businesses that you buy into,
right?
And they give you different things. So an Nvidia will give you a lot of price action, but DBS will give you some of that total return along with the dividend every year, consistent income. Don't forget, in Singapore, dividend income is tax-free, right? So it's almost free money, technically free money, but in terms of you don't have to pay tax on that when you get
so
it.
Attractive.
So compounding that over time, if you can just grow a small position like you are doing and keep doing it consistently, then that can turn into very meaningful income streams later in life.
Definitely. So for those who are looking more of ETFs and maybe less of individual stock picking, are there any relevant ETFs to the banking sector?
Yeah, so Lion OCBC Securities has launched a APAC dividend bank dividend leaders index, ETF rather, and that is mainly just APAC banks. It's Asia Pacific. 85% of it is in APAC, and then you have Australian banks as well, making up about 15%. But the Singapore banks make up a big chunk of that. They have about 21% weighting, I think, in that index. And the dividend yield is really attractive. It's around 5% to 5.5%. But what you're getting is you're also getting that exposure to the regional banks in Asia. So you're not just getting the Singapore specific story. You're also getting Japan, where we see interest rates starting to rise after however many decades, or however many years rather. And that's going to be good for Japanese financials. That's going to be good for Japanese banks. And you've also got certain weightings in Korean banks, Australian banks, and those are going to give you a bit more diversification from a geographical perspective in the bank sector. But the bank sector is very driven by those dividends, by that tie to the global economy, to that sentiment of the global economy. So I think with this ETF, it gives you a bit more of a APAC flavor, Asia Pacific flavor, with some Singapore banks in there as well. So I think it's still it's a great option for investors on the SGX.
So apart from the APAC financial sector ETF that you shared, right, are there any other alternatives as well?
Yeah, so there's something called Thai SDRs, which is actually, it stands for Singapore Depository Receipts, and it allows investors and any of us in Singapore to buy Thai stocks via the Singapore Stock Exchange. And so one of the stocks through that program is actually called Kasikorn Bank, and it's one of the biggest banks in Thailand. And so if you want to get diversification, as we were speaking about, beyond just Singapore, I think this gives you a really good route, because it allows you to tap into the Thai growth story and the overall ASEAN growth story as well. And as we know, outside of Singapore, there are some really exciting economies in the region. And so Kasikorn Bank, via that Thai SDR, allows you to get that exposure to the growth in the Thai banking sector and economy.
Yeah, it's great that we have many different kind of options that we can actually explore, right, for investors.
Definitely.
Yep. On top of what Team has shared so far, Amos, do you have any other burning questions that you want to be addressed in this session?
Let's see. Oh, actually, I haven't asked Tim, how was your investing journey?
Oh, yeah. I mean,
Great question.
Yeah, that's a good question. I started out my investing journey in Hong Kong. I'm from Hong Kong, so I was very much invested from a younger age in certain. I started in bank stocks as well, because my dad got me into HSBC, and that was one of those stocks. So it started from there, that interest. But then I started to venture outside of banks as well and look beyond different industries. And that was in the time when China was starting to list a lot in Hong Kong, and there was a lot of excitement around the Hong Kong market. But you learn a lot from the ups and downs. I was very short-termist back in that day, trying to think about trading on a certain news item or whatever has happened in specific sectors. And I think I learned a lot along the way as well. I mean, you're going to have some wins, but there are going to be a lot of hits that you take. But I think it's better to take those losses and understand and learn those lessons when you're young anyway, when there's not so much capital at risk in
That's a good
relation to
point.
when you're older. And so that was something that taught me to think about what I want in terms of the diversity in my portfolio, with a mix of ETFs, with a mix of stocks, and also given my stage of my career and also my age, I'm also leaning a bit more towards dividend growers, dividend stocks that provide some income, as well as some growth stocks. There's always a mix. I think it's just sizing it in relation to how old you are, what your risk appetite is. And as you grow older, your risk appetite is going to change, because when you're in your 20s or you're just starting, you're going to want to be just buying lots of US tech stocks maybe. But maybe as you grow older, you want to move a bit more into the Singapore banks, the Singapore REITs, and have a bit more of that stable income. And so, yeah, my journey has been very much a learning curve, and I'm still learning even today. So I think it's one of those really interesting parts of life when you invest, because you always learn something new. You never stop learning. You look at Warren Buffett; he's still investing, and he's happy and enjoying life, right? And he's nearly 90, or he's over 90 rather. So I think it's one of those things where your perspective will always change, and you always learn something new, and I think that's great.
Yeah, I really like
Yeah.
that where you mentioned, it's always a learning journey in this investing process.
Yeah.
Yeah, okay.
Yeah.
So there's actually this strategy that we actually saw online somewhere on some online forum that says, when it comes to Singapore banks, maybe you can just buy all the big banks instead of just one, because if one falls, the others are going to rise. Now, what do you think about such a strategy? Is it really true?
Personally, I don't think that's true. But I know people who do that, who
Yes.
buy all three banks. But I personally own DBS. That's the only bank I own. And it's also because I think banks are very, as you said, it's a cyclical, right? So there is going to be some difference in their individual businesses, as we've seen with their dividend rates and their business performance. But on the whole, if there's a recession, all banks will suffer.
True.
It's not as though one bank will suffer and the other two will do well.
Yeah.
So I think it depends on what you value. If you like having a basket, I think that's fine. I prefer to focus on one, and I look at the track record, I look at the dividend growth, I look at the business quality, I look at the leadership. Just go with the ones that win, that do well, that continue to do well, and not just over 5-6 months, but over like 3, 5, 10 years.
But yeah, it's definitely, not always true that when one fails, the others are going to do well, because they are very related in the same banking sector, right? Sometimes, even if it's a bank-specific issue, people might start to speculate, hey, would that actually happen to the other banks
Contagion,
as well?
right?
Yeah, contagion, correct.
People fear that it's going to spread. So it could end up affecting all the banks. Yeah, that's true.
All right. Actually, a lot of young investors, they think that bank stocks tend to be very boring. How do you think you can actually increase the appeal of this bank investments? They think that, maybe I should just invest in the tech stocks in the US, bank stocks that are just too boring, too slow.
Yeah, I think, again, it's more about understanding that there's a place for it in your portfolio, just like there's a place for Nvidia or Tesla or Microsoft or whatever. There's going to be a place for it. I think bank stocks in Singapore actually really suit the slow and steady and consistent investment into the actual stock versus buying. I think the US market, because of how much it moves, maybe there's a lot of traders in there which like to trade.
Yeah.
I'm personally not a trader. I don't trade on the short-term types of movements, but I think that's why people do like the Nvidias, do like the Teslas. Maybe they're going to make 10, 15, 20% in a week or 2 weeks, and they're like, yes. And you won't see that in Singapore banks. But I think that's good. Like, Singapore banks, they know what they are, they own it, and they have an appeal. And I think that appeal is always going to be universal, because dividends are one of those things that will continue to be a big part of your total return. And I think the total return is something we should look at as a really key component of your portfolio, is the share price plus the dividend. And as I said, that dividend really compounds over time if they can grow it. You're getting 5% a year in the yield, and then you compound that by growing it 9, 10, 12, 13, 15%, whatever it is per year. You can really start to earn a lot more from that income in terms of tax-free income to dividend income. And so I understand it from maybe the trading perspective. Maybe you're not going to see lots of really wild swings in the price, and that doesn't excite people. But there is definitely a place for it in terms of long-term investing and keeping it in your portfolio. The US serves a different niche, a different type of investor, a different type of person in the markets. And the banks, I think, has a universal appeal, because I think everyone will need to invest at some point, right? They don't need to trade. Not everyone trades,
Yes.
but everyone needs to invest and put their money away and think about income. And
To
so I
beat
think
inflation.
that's, and inflation, beat inflation. And I think that's one of the great ways to do it is in Singapore banks. They've proved that over 10, 15, 20 years, and they have a really great track record. So I think that's where I stand on how I think about it versus the US. I know a lot of young people, that the US, they love the US, but that doesn't mean you shouldn't also have something in Singapore as well.
Yeah, it's just like how Amos, you have actually both of them, right?
Yeah.
Yeah,
Different
yeah.
allocation.
Yeah.
Personally, for yourself, do your peers also feel that Singapore banks, right, or
Pretty
Singapore
boring.
REITs, are they boring? Do they also share the same
They
sentiments?
do share the same sentiments. A lot of my friends do more on the US side, but there is something very comforting because in Singapore your stocks are actually custodized under CDP, the SGX CDP, versus if you have overseas stocks, they'll actually be in the brokerage themselves. So there's always like some kind of like recurring fee if you don't trade enough on those accounts, and so it's something just very like nice and comforting to know that if I buy like the local stocks, the bank stocks and the REITs, at least they are safe somewhere. I don't have to worry about them like oh no, they're gone all of a sudden one day.
Yeah, right. So
I add to that point as well, because you're saying like it's safe. I was thinking of it safe as in the dividend yield provides a level of support for the share price as well. So that's something else. So if you're buying a really high growth speculative stock and it's not providing any income or dividend, or it's not providing any cash flow or profits, that you could get wiped out sort of 70, 80, 90%, if it's in time, if it proves to be a dud. So whereas I think with the banks, they're big, they're established, they're mature companies. So with that dividend yield, you're going to have a support. It's going to provide some sort of support for the share price, unless when there's massive global recession and whatever. But typically that provides a floor for the share price, and that helps investors stay invested in the stock, and you're not going to see potentially really big drawdowns on bank stocks versus other sectors, maybe in the US.
Yeah. So through our conversation today, Amos, has this actually changed your prior perception of banks, or is there anything valuable that you think you have gotten away from this conversation? And in fact, you can also share with your friends, your peers.
Yeah, actually, this more or less reinforces what I already believe in. And time in the market will always beat timing the market, because even though there are lots of recession, market cyclical stuff, at the end of the day, the fundamentals of the banks are still the same. So you can just keep invested in them and even accumulate more over time. And eventually you will suddenly I have X amount of stocks of DBS, UOB or OCBC bank in my account. Then that's nice. Yeah, so it's very nice to have, it's see something just grow. It's my little child is growing up. It's It's and it also gives me money. So it's
and it gives you money as well.
I know, right?
Instead of taking money away from you, like most children. Or like all children, rather.
Yeah.
Right. Okay. That's nice to hear. So, as usual, right, before we round up this episode, team, could you share with us one final piece of advice that you would like to share with investors who are looking to build up their exposure in bank stocks?
Do your due diligence. Obviously, understand what you're buying, what business you're buying. Look at the dividend yield, but again, look at the payout growth of the dividend payout growth rate, because I think that's really important for understanding if you can beat inflation, if you can stay ahead of inflation in terms of the dividend. And just size your positions correctly. Just have some of those names in there. Just have some of the, I personally, as I said, DBS, but I don't think there's anything wrong with buying OCBC or UOB. Just do your due diligence, understand what you like, what you're comfortable with, and don't buy too much that you're going to lose sleep at night over a recession or anything. But I think bank stocks, they tend to not really make you lose sleep. So I think that's something that I would say is a great thing about Singapore banks. So as I said, I think my piece of advice, do your due diligence, understand the business, and stay invested is the key. Stay invested over the long term and continue to invest into it. Yeah.
Yes, I believe it's really important to just focus on the fundamentals. So some of the key metrics that you shared earlier on, be it in the Singapore market, Singapore banks, or whether it's a global market, global banks. Right. So these are really important. Yeah. So I have a really great time chatting with the both of you, Tim and Amos, on bank stocks. And I believe that bank stocks will still remain as a very relevant player in our equities portfolio moving forward. Right?
Yeah, definitely.
Yeah, so for those of you who are tuning into this episode, and if you're also new to bank stocks, we hope that we have been able to clear some of your burning doubts and queries on bank stocks, and that you have been able to gain some new additional insights on this banking sector. Until next time, keep your FOMO in check, stay informed, and happy investing.
Yeah.
Okay.
Cool.
Yay.
All right, thanks.
If you're feeling fired up and ready to dive deeper, feel free to hit us up. Leave your comments below. We would love to hear your questions and topics that you would like us to cover in future episodes.